The advantage that the North Cape EM product has is it's very, very concentrated, very high conviction approach. So we're looking for a maximum 40 ideas across a universe of 23 countries, very, very diverse mix of countries in the index. And so that means we can position the portfolio in such a way really for any macroeconomic scenario. There's certain countries in emerging markets that are current account surplus, there's current account deficit countries, there are countries that benefit from high commodity prices, there are countries that are casualties of high commodity prices. So the key for us is navigating through the external environment. And since the inception of the fund in 2008, we've seen all manner of economic backdrops, and we have the luxury of looking only for a very, very small idea, hand-picked portfolio, the best ideas for the prevailing conditions. We're long-term investors. So we're looking for the very, very best ideas in emerging markets, fantastic businesses that can grow shareholder value, reinvest in the business with top-line growth. And we will hold those businesses preferably for as long as possible. Our average holding period is 3 years. If we find really, really great ideas, we will hold them much longer than that. It's ultimately the combination of volume growth, which is something which is very, very scarce in developed markets. So here we're talking about toothpaste in India, shampoo in Korea, these kind of long-term structural changes, cosmetics demand in China, combined with businesses that earn higher returns on capital. So these are businesses that create shareholder value. If you get the combination of volume growth and high returns on capital, that's nirvana. And this is what drove developed markets 30, 40 years ago, and it's become very, very, because of aging populations and demographics, it has become very scarce in developed markets. But that is something that emerging markets still offers, and that's what we're looking for in our portfolio. I think we're going to enter a phase in developed markets where monetary policy is tested. So in general, developed markets are running unorthodox monetary policy. So here we're talking about zero interest rates, quantitative easing, and so on. Emerging markets in general are still running very orthodox traditional monetary policy. So we would look for countries in particular that have that orthodox monetary policy. So in other words, have room to cut interest rates as necessary, have not engaged in quantitative easing, have free floating currencies. And so we're talking about ASEAN economies here, India. And at the same time, these are economies that are the primary long-term driver is the what we call the internal engine of domestic demand. So whilst we're seeing this rally in commodity prices at the moment, that's helping some of the commodity countries in emerging markets. Over the medium to long term, we think that global trade as a proportion of GDP is likely peaked, is likely we're going to enter a period of stagnation in global trade to GDP. And as a consequence, you want to invest in economies that have their own internal demand, like India, like Malaysia, Indonesia, and so on. A big challenge within the asset class remains governance. And again, this is why we take a very, very high conviction approach. So if you look at Viktor Orban in Hungary, Erdogan in Turkey, to some extent, to a lesser extent, Bolsonaro in Brazil, this is an issue. I mean, this is a very broad asset class, and governance standards, both at the country level and at the company level, vary tremendously. So for us, with a very high conviction approach, it's about being on top of these developments and making sure we invest in the very, very best sovereigns. So currently we have nothing in Turkey, nothing in South Africa, and nothing in Hungary. And investing in economies where actually governance is improving, because ultimately that improvement in governance, as we've seen in South Korea over the last 20 years, results in a lower discount rate and a strong tailwind for equity performance. a key driver, we believe, this is a structural tailwind on a 5 to 10 year view for emerging markets beyond the kind of existing foundation, which is things like urbanization, the rising middle class in emerging markets. We're also coming to the end, it seems, of a long US dollar bull market. So if you think of the way the US dollar's traded since the Nixon shock, since the US dollar floated freely in the early 70s, there's been broad cycles that have averaged 8 years in length. Well, based on that, we're very, very late in a US dollar bull market. If we then enter a phase, a prolonged period, as I said, the average has been 8 years of US dollar weakness, historically, that's been absolutely the best time to own emerging market equities. If you look at previous US dollar bear markets, the best performing asset class has tended to be emerging market equities. So the timing is unclear because currency is very, very complex, but certainly we're long overdue a US dollar bear market. And that would give us a beautiful tailwind in addition to those long-term structural features I spoke about earlier.